Dear students, welcome you all for the first session of the third chapter of Direct Tax to fourth semester Mangalore University BCom. So in this session, we are going to discuss depreciation in detail. So my presentation in this session will include meaning of depreciation, block of assets, then calculation of return on value for depreciation, then depreciation charge on new assets. So this is the learning objective of the entire chapter, to know the concept of depreciation and calculate depreciation for various assets. So first you have to know the concept, then we can calculate the depreciation for various assets. Then outcome of this session is student will come to know the concept of depreciation and will be able to compute depreciation for various assets. Now let us go to the meaning of depreciation straight away. As we all know, section 32 of the Income Tax Act provides that depreciation can be deducted from the income of business and profession. So it is treated as a allowable item. So but your depreciation should be as per the income tax law. There are certain conditions. It should be calculated on a block of assets. It should be calculated on a return on value of the asset. So these are the rules are there for calculating the depreciation. Now let us know the meaning and detail about depreciation. So as I told you, section 32 of the Income Tax Act provides that depreciation on asset is allowed as deduction while computing the income from business. So it is considered as a allowable item or admissible item, but it should be as per the IT law. So what is depreciation now? Depreciation means gradual reduction in the value of an asset. So that is called as depreciation, gradual reduction in the value of an asset. Now what is this gradual reduction? Because there is a usage of asset every year. As we use the asset every year, there is a reduction in the value of the asset. For example, if you take a pen, so you buy a new pen, and or after that what you do, you use it for writing. So while writing, what happens, its ink get emptied, right? Or sometimes half of the way of the writing it may fell down and it may get damaged. And if you have bought that pen, new pen, for 50 rupees, and now the damaged pen, can you sell it for 50 rupees? No, nobody will purchase it. It will cost around 5 rupees to 10 rupees. So that is what happens for the assets in the organization. Because there is a usage of the asset every year, every time, there is a reduction in the value of an asset, and that reduction, gradual reduction, is called as depreciation. Now what is that asset? Asset can be any asset. It can be tangible asset. Tangible means which we can feel and touch, and intangible asset which we cannot feel and touch. So that is called as depreciation. So asset can be tangible or intangible assets. Then monetary value of an asset decreases over time due to its use, wear and tear, or obsolescence. Obsolescence means getting it old. For example, if the pen is used for continuously 2 years, it will get old, right? Same way for asset also. So in another way, we can describe depreciation as the, here it is a gradual reduction. So there is a cost for this reduction in the value, and that cost is called as depreciation. Nothing but, so it is a also regarded as estimated cost of the usefulness of the asset in the past. So you, whatever the usage that is done in the past, that usage has some cost, and that is called as depreciation, but that cost has to be estimated. Now let us go and understand the meaning of block of assets, because depreciation is charged on the block of assets as per the Income Tax Act. Because an organization will have so many assets, so many number of assets, so all these assets are blocked into 4 or 5 groups, and each asset is added to a relevant group of asset, then the depreciation is calculated. For example, if you consider plant, so plant means it includes so many items such as vehicles, ships, books, surgical equipments. So many items are included in the plant. So this entire plant is considered as one block of asset, and the depreciation rate for all the items which belong to one block, that is called plant, will be same for all the items belonging to that particular block. For example, if plant is one block of asset, if it has so many items such as vehicles, ships, then books, surgical equipment, for all these items depreciation rate is same. then only it can be considered as a block of assets. So depreciation is allowed not on individual asset item but on block of asset. So block of asset means group of asset belonging to a particular class having the same rate of depreciation. This is what I was highlighting, same rate of depreciation. So that means for all the items belonging to one particular group, they will have same rate of depreciation. Then block of assets divided as per the IT law is only four items: buildings, plant and machinery, furniture and intangible assets. So all the different assets which the company has is added to the relevant block of asset. Now regarding intangible assets, it should be acquired only after 31st March 1998. Okay, then only it will be added to the block. So what are the intangible assets such as technical know-how, patent, trademark, licenses, franchises or any other business or commercial rights of similar nature? Then I think I have given this example. So term plant includes ships, vehicles, books, scientific apparatus, then surgical equipment used for the business but excludes tea bushes and livestock. So these two items are excluded from the group plant. Rest all items are included in the plant and all these items will have a same rate of depreciation. Another important note you should make is written down value. So depreciation is always charged on the written down value of the asset. So how to calculate this written down value of the asset? So here is a format. So written down value of the block of asset at the beginning of the previous year should be taken into account. So it will be at the beginning of the relevant previous year. So there will be a written down value. We should take that value. Then if there is any purchases which has happened during the year at any time or addition during the year should be added to the written down value. Then if there is any sale of any asset, then it should be deducted from the written down value. Then we will get the written down value of the block of asset for the depreciation, on which depreciation has to be charged. Depreciation charge on new assets. Now how the depreciation charge on the asset which is brought in between the year, that is the new asset, new addition. So as per the Income Tax Act, depreciation for the new asset which is bought in between the year is based on the usage, number of days of usage. If any asset which is used for 180 days, less than 180 days, then 50% of the depreciation should be considered. If the asset is used for 180 days or more, then full depreciation should be considered. For example, for machinery, if the rate of depreciation is 15%, then if any new purchase of machinery is done during the year, then if the number of days of use is just less than 180 days, then only 7.5% of the depreciation should be considered. If it is more than 180 days, then entire 15% can be considered as rate of depreciation. So this is as per the income tax law. So if any asset falling in block of asset is acquired during the year and put to use during the previous year for less than 180 days, then depreciation on such asset shall be restricted to 50% of the normal depreciation. If it is used for 180 days or more, then full depreciation is charged. So this is how depreciation is charged for the new assets. So that's all from this video. Thank you for watching this video.